the recording of this. Okay, accept that. Okay, all right, good. And basically, the approach I'm going to take tonight to sort of catch us up a little bit is see if I can't get us through the slides for chapter 6, 7, and 8, because we are running a little behind the syllabus. And what I'm thinking is the practice midterm questions are still there on e-learning available to you. And I'm going to let you look at those. And when we reconvene next week on the 27th, I will open it up to questions that you may have about specific questions in those three practice midterms. There's one for chapter 6, chapter 7, chapter 8. We can tailor our discussion around your questions, concerns, pain points with the information in that chapter. And I think that'll then give us some time next week to try to catch up a little bit, because I don't want for us to get to where we short shrift too much the not-for-profit discussion, since that was something that we gauged as an area that was important at the beginning of the term. And I don't want to get caught behind the eight ball that we're just not able to cover that material. I'd rather sacrifice a little bit of the chapters here, 6, 7, and 8, which tend to be a little more straightforward, by not going through the practice midterms, and save us some time that way to get into some of that other material. Okay, so I will go ahead and I will start with the slideshow for chapter 6. I'm going to put my machine in tablet mode, and you know that usually spells some trouble for us, but let's see if we get lucky this one time. Yeah, no. Okay, so let's see if I can go through the process of taking it out of tablet. Go through this annoying process. Okay. And I'll just open them up one at a time here. Okay, no rhyme or reason for that, but it seems to work anyway. I guess that's the only rhyme here. So we're going to talk in chapter 6 about accounting for liabilities, both from the standpoint of, in this, by the way, in chapter 6 will be our last of the governmental funds. We've covered the general fund, special railroad fund. We've covered the capital project fund. Chapter 5, now chapter 6, we're going to pick up the debt service fund, and that'll complete our discussion of the governmental funds. Chapter 7 and 8 will be our two proprietary funds. The internal, chapter 7, excuse me, will be our two proprietary funds, the internal service fund and the enterprise fund. And then in chapter 8, we'll knock out the fiduciary fund category. So that's the game plan. Hopefully we can get through all that tonight. Now, we're going to be talking about, of course, the accounting in the debt service fund, as I just mentioned, but also at our government-wide level. Remember, we still have to use full accrual accounting, and so we would be accounting for long-term liabilities as we issue our debt that is then going to be serviced out of the debt service fund. When we talk about various types of long-term debt, we can have bonds, and that's mostly what our discussion will be, but we'll also touch a little bit on capital leases and some of the accounting. The government is leasing some sort of asset, how that would affect the fund accounting for the debt service fund, or maybe the lease is being counted for in the capital project fund. But we're going to talk about it here in this chapter as the debt service. Okay, taking a look, we have our, sorry guys, I get some glare this time of day and year, and it's a little hard for me to see what I have up on the screen here. The general long-term liabilities, I mentioned the government-wide level, and then how we would account for the debt and the debt service fund. Okay, so the debt service fund basically is going to be keeping track of the payments of principal and interest on general obligation debt. Okay, if there's a specific type of debt that's issued by one of the proprietary funds or one of the fiduciary funds, they would account for the accounting of their debt in their particular fund. But if we have general obligation debt, we're going to account for the debt service, the payback of the principal and interest coming from that out of the debt service fund. And pretty much the expectation here that we're going to see in the example is going to be that the general fund is going to be transferring money over to the debt service fund to pay the principal and interest on that general obligation debt. So in this example, we have a bond that is issued. It pays interest semi-annually. It pays it on January 1st and on July 1st, so every 6 months. Okay, and the question becomes, well, if the bond was, paying 100,000 of interest semi-annually, what would be the interest expense if the bond was issued January 1st, 2025, and it was coming to the end of that first fiscal year ending December 31st, 2025, what would be the interest expense? And the answer here is just the one payment that was made in July. Okay, so the key takeaway for the debt service fund is we do not accrue interest in the debt service fund at year end. We only recognize interest expense when that interest is due and payable. And we're going to see that theme throughout some of the more comprehensive examples that we'll get into. Now, of course, at the government-wide level, using full accrual accounting, the interest expense would be 200,000 in this example, because yes, we would accrue interest at year end because again, at the government-wide level, we're under full accrual accounting. Question on that? Okay, good. So we're going to see that if the debt service fund, we won't actually see this, but if the debt service fund was able to tax, then it would use budgetary accounting and set up estimated revenues similar to what we saw in chapter 4. I think that first part of chapter 4, we dealt with that quite a bit. And then more likely, where the general fund is going to be transferring money over, then the debt service fund would still make a budgetary entry, but instead of debiting estimated revenue, they would debit estimated financing sources, transfer in. Remember, we have our transfer in as an other financing source. And so the budgetary accounting would be to set up the estimated other financing sources. And we're going to see that. Typically, what governments do is there's not this accidental interest issuance of debt. It's not like all of a sudden, hey, they just decide, oh, let's just issue some long-term debt. It's pretty much planned out ahead of time where they know what the outstanding debt is. And so generally what happens is there's an appropriation set up for exactly whatever the debt service schedule is going to be going over time. So we'll have estimated financing sources. That'll pretty much match the appropriation to pay back any principal and interest that's going to come due during the period. And so there will be no effect on the budgetary control account because there's rarely, anticipated to be a surplus. We appropriate what we need to meet the debt service. And in the examples, we're going to see the money's just going to be transferred over from the general fund few days before those interest and principal payments are actually due. In this example, we're going to be talking about serial bonds. Serial bonds mature in installments. So in this example, we have 100,000 and 5,000 of that is going to mature over the next 20 years. It's a responsible way of issuing debt to make sure that when the principal comes due, each year we have the appropriate funds to meet that. If you don't use a serial bond approach and you use a term bond approach, then we're going to see that a debt sinking fund, where money is literally a saving account, money is set aside to meet the principal when it comes due at the end of the term on a term bond. Is Carmen here? Does the city and county have a preference as to the type of bonds, or they tend to be serial, or do they tend to be
Yeah,
um,
they tend to be serial. We don't really have a sinking fund that we use. We tend to budget for them on an annual basis.
okay, good. Well, I have a quick example of how you'd set up the savings for a sinking fund. So we'll spend appropriately. It turns out most of our time looking at a serial bond. So in this example, the bond gets issued January 1st, December 1st, 2024, and the interest of $3,000, 100,000 times 6% semi-annually is 3,000 every 6 months, is going to be on June 1st and December 1st, 2025. And then that will continue for the next 19 years after that. And so the first principal maturity of 5,000 is due on December 1st, 2025. So we're going to have two interest payments, 3,000 each, that's 6,000 plus 5,000 principal each year. And so again, for this first year anyway, we're going to have to appropriate and pay out interest and principal of $11,000. Okay, so at issuance, okay, for our government wide using full accrual accounting, there will be a debit to the cash that comes in of 100,000. They're assuming they're issuing these bonds at par, and we will set up a long-term liability serial bond payable. Now, I found it interesting that this particular example for the textbook just went ahead and rushed us here to for the first payment in 2025, which is going to be in June of 2025, and started talking about the appropriations and whatnot that would be set up. But I think it's worth noting here that at the government-wide level, okay, for 2024, since we issued those bonds on December 1st, you would accrue the interest at year end for government-wide purposes. So you'd say the 100,000 times 6% times 1/12, whatever that comes out to, and you would debit the interest expense and credit interest payable using full accrual accounting at the government-wide level. At the fund level, and the textbook just sort of jumped to, what would start to happen in January of that next year. Nothing would be done December 31st, 2024 at the governmental fund level. That accrual entry that I mentioned would only be made at the government-wide level. Okay, so we take a look, and hey, we have two interest payments, June 1st, December 1st, each 3,000 that first year, 5,000 for that first installment of the principal. So as I mentioned, they go ahead, and I think this is fairly common. There's generally not an amount that's going to be transferred over in excess of what's needed to meet the debt service. And so we would simply debit estimated other financing sources, meaning that what money's going to be transferred from the general fund to the debt service fund. The debt service fund is going to have this money coming in, and credit the appropriation as the appropriate payments are made on schedule per the debt covenant, whatever that is. Governmental activities, we typically don't worry about making budgetary entries. Okay, then a couple of days before that first interest payment is due, we would debit the cash, credit the other financing sources, transfer in for 3,000. By the way, the general fund is going to be doing what? Debiting other financing uses, transfer out, and crediting the cash as it comes over to the debt service fund. And now the debt service fund has the money that it needs to make that first principal, that first interest payment. Principal is going to come in December. And so we would just go ahead, debit expenditure, bond interest, and credit the cash. And at the government-wide level, we would debit interest expense and credit cash. Okay. Now, on November 29th, a few days before December 1st, when the next interest payment and now that first principal installment is due, an additional 8,000 3 for the interest, 5 for the principal. Is transferred over, debit cash, credit the other financing sources, transfer in, debit the expenditure, and note, guys, using the character. Well, this is probably more of an. This is probably more a object class approach, I guess. We would go ahead and debit expenditure. Well, I guess it's to call it debt service, okay, and paying. It's, I guess you could say it's a character designation because assuming if we issue debt, we're trying to do, benefit future periods. So when that money is received, we would go ahead and debit cash, credit the other financing sources, transfer in, and then as the payments are made, then debit expenditure for principal and interest and credit cash. At the government-wide level, we would go ahead and debit the interest expense. For the principal portion, because we set up the long-term debt, we're literally going to debit the liability, serial bond payable, and of course, credit the cash. Okay. Here they bothered to show the adjusting entry that would be done at December 31st, 2025 for that first, for the 2025. They didn't show that for 2024, which there would have been that too, because we issued the bonds on December 1st, 2024, but it would be that same calculation that I sort of called out before. And this would be the accrual of the interest at the government-wide level. Again, you do not accrue interest under modified accrual accounting for the governmental fund, so nothing would happen in the debt service fund. Notice we recognize that expenditure as the payments become due and are then obviously paid. Okay, and then of course we close our budgetary accounts, we close our proprietary accounts, our expenditures, and our other financing sources. Okay. Okay, good. Now, term bond, and again, term bond, the thing that, I just want to note here is if a entity was using term bonds, many governments will set up a bond sinking fund. And so the way to calculate what would go into the bond sinking fund would be to say, well, look, if I have to get 100,000 together at the end of 5 years in this example, how much would I need to put aside each year in this example, even though I think it's anticipated there would be a semi-annual contribution, but they just want to show you the annual contributions here. How much would I have to put away each year in order to have the 100,000 that I would need at the end of 5 years? So it's basically a savings account type of a thing where you set it up. Future value of an annuity factor times X equals 100,000, and then divide each side of that calculation by the present value factor, and that tells you how much you would have to contribute to each year in this example to have the 100,000 needed at the end of the period. Again, if you're not using sinking funds, it's probably not something you'd get into very much. Okay, we did mention if there is a special assessment debt, special assessment, only those that are being benefited by, say, a capital project get taxed for the particular payment for whatever the project was that benefited specific taxpayers. I don't know. I see a common example, street lights being put in a certain neighborhood or something, and only those individuals get assessed. And if the government would be potentially primarily liable in the event that those homeowners don't pay the special assessment, then the activity in that special assessment, the paying back of that bond or whatever that was issued for those streetlights, would be accounted for the debt in the debt service fund. If the government is not somehow potentially primary liable, then that would go to our custodial fund, and we'll see that mentioned again in some of the literature that we'll look at when we get into Chapter 8 in the fiduciary funds. Okay, capital lease agreements. I'm not going to go too far off into capital lease accounting here. For the governmental activities, if equipment is leased, there'd be a debit to equipment, credit to capital lease obligation, a liability. Not very surprising there since the lease term is 5 years. No, they didn't say it was 5 years. See Chapter 5, but it's assumed it's a long-term lease here. Okay, capital lease is typically long-term. If we are looking and we're seeing that, hey, we're paying back that lease out of the out of the debt service fund, then as we start to make those lease payments, a portion is interest, a portion is principal, but we just recognize expenditures, of course, out of the debt service fund. So that entire payout of the lease obligation would be a credit to cash and a debit to expenditure using modified accrual accounting. If we were dealing with the government-wide, which I don't think we show that here, then some of that would be a reduction of the principal on that lease, and some of that debit would be towards the interest expense associated with it. Any question on anything from Chapter 6? Okay. Let me see if I can get out of this. And, okay, Chapter 8 is opened. Chapter 7 still open. Yeah, it is. Okay, let's see. Okay. Still writing. Okay, that's good. Okay, maybe we're going to get a little luck tonight. Okay, so Chapter 7, proprietary funds. Okay, so we're done with the governmental funds. We're done with the notion of modified accrual accounting. Everything now is going to be what? Full accrual accounting. And the key takeaway from this chapter, I think most of it is almost I would say a review of, introductory to accounting, because it's anticipated it's a business being run inside the government, either an internal service fund or an enterprise fund. When I look at this stuff, the part that I find kind of interesting, and it's different from commercial accounting that you're probably aware of, is the structure of the statement of cash flows. Only the proprietary funds prepare a statement of cash flows. So we're going to take a look at that and see how it differs from how you might have seen in a commercial version of a statement of cash flows. Note also that when we get to our governmental fund, our proprietary fund balance sheet, it's full accrual. So we have what? We have assets, both current and non-current. We have liabilities, both current and non-current. And when we get to the net position, okay, unlike how we saw for our governmental fund balances, where they're called out in the 5 categories, right? We had what? Non-spendable, and then we had our restricted, our committed, our assigned, and our unassigned. Here we only have 3 categories: restricted, unrestricted, and net invested in capital assets, net of related debt. And I've given you a mnemonic to help you remember that if you were to be tested on that run. But remember, we talked about these same categories of net assets, net position, excuse me, when we were talking about the government-wide statements, and we talked a little bit in depth about that for the government-wide statements. Same logic here, same structure here for our proprietary funds. Okay. All right, good. So we're going to use accrual accounting. Okay. We are not going to be making the budgetary entries. That's not to say, with the estimated revenues and whatnot, that's not to say that we wouldn't use a budget. We probably would use a flexible budget. And when we talk a little bit more about budgeting in some of the upcoming chapters, we'll talk about how you would use a flexible budget We will have fixed assets, therefore we will have depreciation being reported. Okay. Okay, so very similar to business type entities, we have three financial statements: statement of net position, which is like the balance sheet, statement of revenues, expenses, and changes in fund net position, which is the operating statement or income statement, if you will, although we don't have income determination really as an objective for our proprietary funds. And then, as I mentioned, statement of cash flows is only prepared for our proprietary funds. And we're really going to see how the governmental version per the standards of the Governmental Accounting Standards Board differ from the approach that would be used under the Financial Accounting Standards Board's requirement for private sector entities, both public and non-public companies. I find the governmental version, and maybe I'm just, government head or something, I don't know, but I find it a much more useful approach than what we see for commercial. And I kind of look at it, and I think that FASB came out with their requirements for statement of cash flows first. And then GASB came out with their version, and it's almost, you can almost see them saying, well, this is probably what FASB should have done. We'll do it for you in the governmental version. And so I think that FASB really should, in my personal opinion, they don't ask me, should really, adopt the GASB approach for commercial entities as well. But anyway, like I said, they don't ask me that. So, okay, when I say they, FASB doesn't call me up and say, what do you think lately, John? Okay. Now, again, for our statement of net position, we've already seen the three categories for our net position: restricted, net invested in capital assets, net related debt, and unrestricted. And again, same approach at the government-wide level. We spoke a little bit about the nature of what would go into those categories of net assets when we were talking about government-wide. Okay. For our operating statement, for our income statement of revenues, expenses, and changes in fund balance, very similar to what you would see in commercial. So we're going to have what? Operating versus non-operating section. And you're going to see that that's quite familiar in determining the change in net position for the period, which is analogous to net income. Okay. Statement of cash flows. Okay, now when we look at the statement of cash flows, we're really going to look at it from a standpoint of, well, this is what FASB is requiring for private entities. What do we expect to see for government entities that is different? By the way, note here, guys, I'm talking simultaneously about both proprietary funds, the enterprise fund and the internal service fund. We'll talk about some things that are unique to each of those after we were done talking about the things that are the same across the two categories of proprietary funds. Okay, so take a look, and I listed the 6 differences here. Okay, so the GASB statement of cash flows statement divides financing activities into whether they are capital related or non-capital related. Very useful set of information as to how an entity is spending its cash. Is it spending it just all on short-term type things, or is it spending some of its cash on longer term? I think that would be useful both in commercial and in governmental. And so again, you can almost feel the GASB fixing some things that don't happen in the commercial version. Acquisition of capital assets is a capital and related financing transaction under GASB rather than investing. I see this as something that happens in government. I don't know that the FASB version would want to do this, in that in governments, often the money that comes for investment in capital type items comes from some other funding source outside of the government. And so they've decided it's appropriate to treat that as a financing activity. Interest expense on long-term debt is capital and related financing under GASB rather than operating under FASB. To me, this is something that the FASB should do as well. They treat interest expense and revenue as an operating item. And the reason they have to do that is because under the indirect approach, which by the way is not allowed under the GASB version, they're reconciling net income to cash provided by operations. And so since you're starting with net income, you got to stick interest revenue and interest expense up in the operating section instead of putting what your interest expense in financing, where it probably belongs, and interest revenue, putting that in investing where it probably belongs. Okay, so you can see that next item, number 4, interest revenue is considered investing rather than operating. Okay, so they're treating interest a little more wisely, a little more, I don't know, wisely, but more practically, I think is the better word, than under the commercial version. Cash flows from operating activity must be shown using the direct method. And by having cash flows from operating activities, and then when you go to show the reconciliation, instead of showing net income to cash provided by operating activities, you show operating income to cash provided by operating activities, is a much more useful approach, since the income statement in commercial often treats interest revenue and expense as non-operating. And then all of a sudden we need to get over here and start treating it as operating the statement of cash flows. Gets confusing, hard to explain to students why that is, hard to really explain all the adjustments that are going on, and weird adjustments in some cases that are going on in that statement of cash flow as a result of that. By reconciling operating income to cash provided by operations, you get rid of all that nonsense. Okay, so I put up here, and I know it's a little hard to see, but I put up here side by side an example of the statement of revenues, expenditures, and changes in fund balance for our proprietary funds, and the statement of cash flows. And notice here, guys, that we're picking up this number operating income right here. Okay. And the reason I wanted to show them side by side is that then when you get to the statement of cash flows, and you can see the 4 categories and whatnot that we mentioned, but when you get down here, because you still have to provide the reconciliation, and in the commercial version, it's a reconciliation of net income to cash provided by operations, or if they use the indirect method, that's pretty much all you see is this section there of net income to cash provided by operations. It gets strange, and there's some weird things that get very difficult to understand. Here, by reconciling operating income to cash provided by operations, you get a nice look at, okay, this was the full accrual, operating income, and now here's how cash was generated from operating activities. Very useful set of information, in my opinion, the way this is presented. Okay, all right, good. Some specifics about some of the proprietary funds. Internal Service Fund first, motor pools, etc. I think we talked about some of the internal service funds in the city in some of our earlier chapters. Okay, Internal Service Fund pretty much should be recovering costs. And I think I told this story where federal agencies were sort of looking at internal service funds of entities that they were providing funding to, state and local governments, to see if those internal service funds were showing an increase in what was at that point called the retained earnings. That's now essentially their net position. And if they saw large increases, they were literally going down and saying, hey, why are you generating a profit out of your internal service fund? Because profit is not an allowable cost under federal guidance. And so they were able to recover some funds that way. That was back when the federal government maybe took more of a surgical approach to looking and having oversight of what was going on with federal funds. Okay. So it should be on a cost recovery basis. Okay. when the internal service fund provides service, okay, the internal service fund will debit due from the general fund, which is like an account receivable. Credit billings is sometimes used as the account name, but it's essentially an operating revenue. And I just put down here, in the general fund, there being a debit to expenditure and due to the internal service fund, and then eventually that liability would be liquidated as the money sent over to the internal service fund, and the internal service fund, of course, would debit the cash and credit the due from. So that's a revenue account. Billings is. Sometimes I point that out because sometimes I'll have students, not you guys, but I'll have students that would get confused and say, billings, that's a liability, right? Kind of sounds like a liability. No, that's revenue. Okay. As we mentioned, the government internal service fund is included under governmental activities section on these government-wide statements. And so there would need to be a let me say it the other way. Unlike with the governmental funds, where you would need to make adjustments from modified accrual to full accrual to report to the government-wide level of government activities. For our internal service fund, we don't have to do the conversion. We just simply need to consolidate the activity of the internal service fund to the governmental activities column to prepare our government-wide statements. Okay. Enterprise funds. Okay. Activity that is financed with debt that is secured by revenues, or law regulation requires that the cost of the activity be recovered with revenue from the activity. And that's when you start saying, okay, this needs to be treated as an enterprise fund. Water and sewer is the classic example. We don't have toll roads in the Bay Area, but often bridges would be accounted for as an enterprise fund. You can see some of the others here. Okay. Assets whose use is restricted need to be called out as such. For example, customer deposits. Since I live here in Hayward and we get Hetch Hetchy water here, thank in my part of Hayward. Some parts of Hayward get East Bay mud, and I'm here to tell you Hetch Hetchy is much better than the East Bay mud water. And so I noticed when I was looking to see if enterprise funds were restricted for the annual comprehensive financial report for the city, I did see a call out for Hetch Hetchy, and there were some restricted funds for customer deposits, that kind of thing. Often when you look, cash that is restricted is often reported after other assets, because it's seen after other current assets. For example, you'll see receivables and then you'll see the cash that's restricted. It's almost seen in some cases as maybe it's a long-term item, depending on how long those amounts are going to be held, like customer deposits. Typically, I don't think they go much beyond a year, but usually, there's customer deposits required because either somebody is new to the utility game, maybe a kid, trying to get started, and they make them put a deposit down at first, or if you've had somebody who's had experienced some trouble in the past paying their bills, they may make them put a deposit down, and then that cash is usually kicked back to them after about a year or so. Okay. Okay, good. So you can see some of the things that, might constitute liabilities. Again, those customer deposits, we're debiting the cash and calling it out as restricted. And of course, we're setting up a liability because the notion is that that money would be returned after, like I say, a year or so. Okay. Bonds, long-term debt, full accrual accounting, you'd follow something very similar to what we were looking at in chapter 6 for the government-wide statements. Okay. Municipal landfill, does the city run any landfill at all, Carmen? Is Carmen still with us? I didn't see anything. Okay, but if there was some,
No, we don't. Sorry, I couldn't unmute myself.
no, that's okay.
Yep, we don't.
Um, this is, I don't know, here for fun, I guess. What happens, is the entity would need to estimate. So EPA came down some years ago and says, hey, look, you've got this festering hole of garbage. And if you think you're just going to, leave it there, think again. We're going to require you to clean it up. And again, the federal government, although I guess some people argue this these days, but the federal government looks down and says, hey, we have different states that are right next to each other, and bad environmental policy in one state could affect another state. So it's almost looked at as interstate commerce. So federal government can come in and legislate what happens. Oh, if that's going to continue much longer. Anyway, I'll shut up. So what happens? Money goes into, money doesn't go into, but they are required to figure out, well, what is going to be the cost of this thing to clean this thing up? And they figure out the different things. You can see cost of construction and whatnot, gas monitoring equipment, whatever they have to do. And they estimate, okay, these are all the costs that we're going to have to incur when we finally have to clean this thing up. And so let's say they estimate $1 million here in this example, which I think it'd be a lot more, but they estimate $1 million. Then what? Then as they fill up that landfill based on engineering estimates of how much of the total available space in this landfill they used up, and my little example here, let's say they used up 20%, then they would debit expense and credit liability in the enterprise fund for this to set up a liability for the day that'll come down the road when indeed they will need to have resources available to pay this. Then once they go ahead and they start spending the money to clean this thing up, they'll go ahead and debit the liability and credit the cash. And there's usually a discrepancy between what they've put into the liability and what ultimately they have to pay. And if that's the case, there'd be an additional debit to expense at the time that they have a difference. Okay. So that's pretty much, that slide is saying what I just said on that example. Okay, good. That takes us through chapter 7. Show. Discard. Let's see if I can close that. Okay, I guess that means I closed chapter 8 too, but I can reopen it right here. Okay, no, it's still open. And let's look at chapter 8. Okay, so now in chapter 8, we are going to look for our fiduciary funds. Okay, fiduciary funds, we have our custodial fund, and then we have our trust funds. Again, we're using full accrual accounting here. Okay, and when we look at our trust fund, we'll have the investment trust fund, private purpose trust fund, and the pension trust fund. And then we have our custodial fund, which technically is not a trust fund, so that's why we didn't call it out there, but we will get to that. So statements, 2 statements required by our fiduciary fund: statement of fiduciary net position and statement of changes in fiduciary net position, like a balance sheet, like an income statement. No statement of cash flows. That is only prepared by our proprietary funds. We don't even have a government-wide statement of cash flows. Okay. Okay, good. Now, when we take a look, assets are valued at fair value, okay? And you can see why that might be the case for a retirement plan, right? And kind of makes sense that we'd want to see what the investments and whatnot are being carried at their fair value. Okay. We have our payables, we have our net position, which is like our retained earnings. Okay. And then for our operating statement or statement of changes in fiduciary net position, our additions, okay, are like revenues. Our deductions are like expenses. And of course, we have, please God, investment earnings, right? That'll come in. And this is really, sort of a typical pension defined benefit plan, which governments are probably the last standing bastion of pensions still going on these days. I guess there might be a few companies like some of the airlines and whatnot, I guess, that have maintained pensions, but we're lucky, I guess, that as government servant, civil service, you guys still have a defined benefit plan, please God, right?
Yeah,
Yeah.
we do.
Okay. Yeah. Okay. Good. Keep that up. Okay. So we have our um, additions, which are our revenues, and our investment earnings, and our deductions, which are like our expenses. It's pretty much payments of benefits. And then if someone leaves and they've made contributions and we have to refund them, that would also constitute a good section of our expenses, which we call deductions. Okay. There's a lot of guidance, a lot of the disclosures and whatnot that you see center around pensions. Okay, and so if you're interested in taking a look at your annual comprehensive report, a lot of that required supplemental information other than MD&A centers around the pensions. Okay. It's worth noting, okay, and I don't know if it needs to be this red thing, but whatever. It's worth noting that when the contributions are made to the pension fund, okay, that's generally coming out of one of the other funds. If it's, say, the general fund that's making the contribution, at the time of contribution, that's treated as an expenditure, right? And so it's worth noting that the contributing fund would recognize the expenditure to the fiduciary fund, say the pension fund, that's going to be what? That's going to be an addition as those contributions are made. And of course, the employees, I'm assuming these days you guys also contribute, right? To the pension?
Yes.
Yeah. That's typically the model now. That's the federal government some years back went to a hybrid model where you contribute to something that's a defined benefit. The employer, the federal government contributes, and you have they call it the thrift savings plan. It's like a 401k component as well, and that's how you're supposed to end up with your retirement in the federal level. Okay, again, note disclosure, and then we're going to talk at the end of this chapter about the reconciliation from the fund balance to the statement of activities, net position, and pension generally is a major ticket item on there. I looked at yours and you did have an adjustment for pension. I'm going to show you a much simpler example of one just so you understand the mechanics of the reconciliation from from fund balance to net position. But you can look at your own and you'd see that pension is a big part of that. Custodial funds, common use is a tax custodial fund. So often what happens is the county is the entity that individuals pay their property taxes to. So you pay your property tax to the county, and then the county then holds that in a custodial fund and then will remit those funds to the various cities within their jurisdiction, per wherever, whatever, address paid those property taxes in for that city. Okay. So, as we've mentioned, special assessment debt, if the government is not somehow potentially liable for that, the payment of that debt is going to be accounted for in a special assessment custodial fund. Okay. Okay, so let's just go ahead and take a look at the financial statements for the custodial fund. And you can see that they have cash and receivables sitting here. And then notice that pretty much all of that cash is going to be due to the various cities within the jurisdiction of that. In this example, I guess they'll call it a county, but county is usually the one that collects the tax, at least here in California. And then there's some small amount that's left over. Sometimes those funds are available to cover any sort of administrative costs, etc. When we look at the operating statement, additions are like revenues, the money that's getting collected. Deductions are the payment of the expenses. It used to be that the old standards that the custodial funds, which they called agency funds at that time, only showed a balance sheet because all that money was going to go eventually, or almost all of it was going to go to whoever they were holding that money for. Then they made some changes years back where they asked for a operating statement as well. So we get into this weird kind of dance now where they go ahead and they take in the cash, they credit additions, and then for the amount that they're going to have to send out, they debit deductions and credit a liability. And then when they go ahead and finally liquidate that liability and pay it out to the various cities or whatever in their jurisdiction, then they debit the liability and credit cash. I guess it makes sense that we need to see an operating statement. I was fine with the old days where they just showed us the equivalent of the balance sheet, the statement of fiduciary net position, but they don't ask me these questions. So, okay, but you can see pretty much everything that comes in gets paid out. So, okay, good. Small net position. This example begs the question, where'd the 95,000 come from? It seems to me like that net position number. And I think I called the guy that put this example together and he said he was going to change that and he never did. But in the latest stuff I looked at, but it seems like that number would hover relatively small. I don't know why it would be, this so much bigger. 95,000 is a lot bigger than 12,000. I don't know why the total amount wouldn't hover around 12,000, since most of the money is going to be paid and then collected and then paid out. But anyway, probably a minor point. Okay, good. Trust funds, investment trust fund, private purpose, and pension. And we sort of already talked about pension a little bit. Investment trust fund, does this county manage any investments for any? I didn't see an investment trust fund, Carmen, or did I miss it?
It's not called investment trust fund. It's called what do we call it? I have another term for it.
It's okay.
Yeah, it's our other fund. We do have one. It's our treasury basically because we hold funds for other governmental agencies as well as our own government.
Okay, right. And that's the job of the investment trust fund is to account for investments that are being managed on behalf of others,
Yeah,
not the city's own.
right.
Thus the term, that's why it's a trust fund, a fiduciary fund, right? Okay, good. Now, what I thought was interesting is this idea of allocating gains and losses. And so since I'm over here in Hayward, I'm born and raised in Hayward, I decided I'd use an East Bay example, Alameda County example. And this is made up, guys, completely made up. And I'm saying, hey, the entities in Alameda County have their investments, and then they decide to join the Alameda County Investment Trust Fund. And sometimes they'll do this because you can save on brokerage fees and whatnot if you just manage it all as one big pool, one big fund. And so when they establish the investment trust fund, the various cities give up their ownership in that asset. And now they just have a share in the what I'm calling the Alameda County Investment Trust Fund, ACITF. And so you notice the investments that they have turned, instead of the specific investment, the stock and the T-bill, now they've turned into a share of an investment in the Alameda County. But notice on Alameda County's financial statements, they don't account for their part, even though they're maybe managing that all as one fund and saving brokerage fees and whatnot. The accounting is that they still carry it on there, and I'm assuming in the general fund, as an asset that they have in their possession on their general fund balance sheet. And then when you look at the investment trust fund, they're only talking about the 200,000 stock for Union City, Fremont, for a total of 4, and the 500,000. And they're listing those investments that they have in the Alameda County Investment Trust Fund, those that they're holding for outside. Now, this notion of allocating the loss accordingly, and what I did was I says, well, let's say the corporate stock lost all of its value. Okay, so now it's lost 400,000, 200,000 for Fremont, the 200,000 for Union City. And so that's a $400,000 loss. Notice that they share in proportion to what their share was in the trust fund. So Hayward's getting, you know what, here, because they had a nice T-bill. And now what they've done is they've suffered, and they had to absorb 50% of that loss, since they were responsible for 50% of the assets in the investment trust fund, and the others got their share, but they, kind of benefited from this relationship in a way. And then on Alameda County's financial statements, they would basically still have their T-bill. I assumed it didn't lose any value. T-bills start losing value, we're in trouble, right? But notice that they did have to recognize that, hey, we're now in the whole 40,000 that we really owe to the Alameda County Investment Trust Fund. So they set up that due to, and then notice that the investment trust fund still has the T-bill, the one they got from Hayward. The corporate stock is now 0. And they do have the fact that, the general fund should at some point settle up and send over their share of the loss to cover the loss, their share of the loss from the trust fund. Okay, key takeaway there, guys, is this sharing the losses proportionately, and this notion of, the outside assets are the ones that are accounted for in the investment trust fund. If the entity itself, the county in this example, holds an investment, they account for that in their financial statements. Whatever fund holds that accounts for that there. Okay, private purpose trust fund. There's a couple of different things. For example, I've seen where, as example, maybe a police officer is killed in the line of duty, and what the entity will do, say the city, is they'll set up a trust fund for, surviving victims, the children of the police officers, whatever. They'll set up a fund for them, and it can use for college purposes or something. Well, those funds don't belong to the city. They belong to what? To the children of the slain police officers. And sometimes it happens where it starts out as a private not-for-profit entity, and the thing takes off and gets so big that the private entity will turn to the city and say, hey, or the county, and say, we would really need you to manage this for us, because this is a pretty good chunk of money. And so that would be accounted for in the private purpose trust fund. The other one is escheat property, unclaimed property. This is typically something you see at the state level. And so if you have a bank account, let's say, and you forget about the money in that bank account for some reason, maybe it's a small amount, you set the account up years ago, or maybe you have a relative that passes and you never got around to clearing out a smaller bank account or something. Eventually, the bank is required by law, they can't keep it. They're required by law to send that money over to the state. And then later on, when you go to maybe claim that money, you can't go to the bank to get it. You have to go to the state to get that money. Now, that should be set up as a liability in an unclaimed property fund and an escheat fund. But what I find interesting is they estimate of all the money they get, they only set up a liability for the amounts they think are going to be reclaimed. And sometimes they'll just account for that all in the general fund because it's so immaterial as to the amounts that they think will ultimately be reclaimed. So what I used to do is I would go in towards the end of the year and I put all my family's members' names in. Well, I started doing this because I did a lecture on the way these cheat funds work, and I had a student send me an email says, "John, I went to the unclaimed property site that you mentioned, and I Googled, I put not Googled, but I put your name into the search engine just for fun, and you've got some money coming." And it was like 900 bucks. I had sold a house, and for whatever reason, I had an impound account. I used the same insurance company to go from one house to the next, but for some reason, the insurance company couldn't find me to give me the money that I was due out of my impound account for my insurance. And so I claimed the money, and you have to give them like identification and triplet to show that you're really the person and whatnot. So after that, it's like, well, hell, I'm gonna do this, and towards the end of the year, I'll put all my whole family in there. And my brother had 50 bucks coming, and I don't know why he never could bother to reclaim that money. So every year I have to sit there and see that same 50 bucks that my brother, for some strange reason, refuses to. It's 50 bucks, and he doesn't want to go through the trouble of reclaiming it. I have received letters from CPA firms saying, we'll help you recover money. And it's like, for a percentage, which to me is a big scam. You don't need a CPA to help you recover that money. You simply notify the state, you search on there, you see that you've got some money coming, and then you go through the process. It's not a big deal to get that money back. Question. Okay. And again, they frequently elect to account in the sheet property in the general fund because the collection on that stuff is so low. People just don't realize, I guess. Okay. Reconciliation. Okay. So there are two reconciliations that the city prepares. I took a look at both of them. One reconciles fund balance at the fund level for the governmental funds. Two, net position under the governmental activities column. Okay, and we had talked a little bit about that before. And so you just start with fund balance, and then you start doing things like adding back fixed assets. Fixed assets are accounted for at the government-wide level, not at the fund level. So you add back the fixed assets, subtracting out long-term liabilities. They're not accounted for at the individual fund level, but we do have them and report them at the government-wide level. Remember we talked about differences between modified accrual and full accrual for revenue recognition. And remember that if some revenues were going to creep outside of that, we were assuming 60-day, then it would still be in deferred inflow at the fund level, but at the government-wide level, we would recognize that revenue as soon as we entered, say, into that next year, and we weren't sort of having to worry about that collection period. Well, if we had some that were going to fall outside of that collection period, but we had already recognized them, we could recognize them already for government-wide purposes, we would add that back. That's that 125,000 in that example. And then remember, because the internal service fund is treated as it's a proprietary fund at the fund level, not a governmental fund. But when we get to the government-wide level, it's in the governmental activities. We'd have to add the net position of the internal service fund in there to reconcile up to what's reported net position at the government-wide level. That's the reconciliation of the balance sheet. The reconciliation of the statement of revenues, expenditures, and change in fund balance has a similar approach, but it reconciles, if you will, the net income numbers, the change in fund balance, the change in net position, and then has a similar approach. And the big thing here is saying that now what? Now we're having to subtract out depreciation expense, okay? And, if we acquired any assets during the period that we treated as expenditure, we'd have to add that money back, etc. Those sorts of things. Question on any of that? Okay, guys, I'm going to go ahead and adjourn the class here. I'm not going to go through those practice midterms. There's 3 of them. I'm going to invite you to go ahead, and you may want to do that tonight. Spend a little time looking through those practice midterms, and then by next time, I'll open it up to questions. If you have any questions about any of those items in those practice midterms, we'll address those at the start of next class. And then I want us to start to jump ourselves into that chapter 9 material dealing with consolidating the government-wide statements, preparing those, and also start to look at some analytics of government financial statements. Try to knock those 2 chapters out so we have sufficient time for the not-for-profit stuff. Question? Okay, guys. Have a good rest of the evening. Carmen, did you want to talk at all about what we talked about last week? Or are you still in progress on that?
Oh, no. Yeah, definitely. If you have a minute, we could talk.
Sure.
Yep.
Yeah, let's go ahead and let folks adjourn. I'll end the recording. Folks exit the meeting. I will stop the recording, and then we can talk in a couple seconds, Carmen.